Hello, everyone. Welcome to the Weekly Watch. I'm John Briggs. For once, markets seem to be settling down a bit, helped, in my opinion, by the fact the Fed is in blackouts. Individual Fed members can't constantly hit the airwaves and update their views on the size of the upcoming hike in real time. Also helpful was the fact that most of those members towards the end of the pre-blackout period guided markets to 75 basis points, which is what markets are mostly priced for. I'm going to come back to the Fed, actually, because I have NatWest's chief U.S. economist, Kevin Cummins, with me here today. But first, I want to look at the results of the ECB meeting, which came out just a little bit before the recording of this podcast. And those results are certainly eye-opening, as the ECB chose to raise rates by 75 basis points despite prior guidance to gradualism, which had most looking for 25. Personally, given the inflation outlook, it's clear that negative policy rates are simply the wrong rate in this environment. So I think this is the right adjustment, but only one that could have been made if they also revealed their anti-fragmentation tool at the same time. Because a larger than expected rate hike and no tool would have sent peripheral spreads widening, especially with the current political backdrop in Italy. Note the announcement didn't tighten spreads, at least not yet as we record, but there is that political uncertainty, so it's tricky to separate the two. We'll have more on this TPI, which is the anti-fragmentation tool, soon. But for now, the ECB is on the move, and given this hike against their prior guidance, investors need to be alert for more of this in the future, meaning take central bank's word for what it's worth, which is limited in this environment. All right, so that's where Europe stands. So let's look forward to the Fed in this coming week. Kevin, thanks for joining me today.
Thanks, John.
First off the bat, you've been at 75 basis points this meeting for some time, not budging when markets started to think 100 for a little bit last week. So there really is no chance they go 100, or is there, given all these surprises we've been getting from central banks? And despite what they've guided to do, what do you think they should be doing given the inflation backdrop?
Yeah, well, I think, the clearly there's a little bit more risk than normal, just given the fumble that we saw ahead of the June FOMC meeting when, during the blackout period, the Fed got, really concerned about the May CPI report and probably, did the right thing by hiking 75 basis points, despite, making it pretty clear that they were on track for going 50. But just the timing of it, adds unnecessary uncertainty that obviously financial markets don't like uncertainty. So I think while the action is probably the right decision, given the strength that we've seen in inflation, the delivery was pretty messy. The Fed officials in general, and the chairman in particular, are invariably criticized and second guessed, regardless of what they do or what they say. But the delivery there of during the blackout period, leaking it to the Wall Street Journal that they're going 75 was pretty messy, and I think they want to try and avoid that. So it was pretty clear after last week's, even though the CPI for June was stronger than expected, the inflation expectations measures were a little bit mixed that we got on Friday, and retail sales suggested more momentum in the consumer at the end of the second quarter than we thought. The Fed was better behaved in that you got an overall message, a consistent message from most Fed officials that were willing to say with the action that they expected to go in the direction of 75 basis points next week. So, I think the Fed, hopefully learned its lesson. I mean, it was a little bit surprising that Chair Powell, at his semi-annual monetary policy testimony, shortly after that whole, the change, the last minute change, was willing to even again say that they're 50 or 75 basis points is the likely path for July. I think hopefully, he's kind of learned his lesson and is a little less committal about the exact size of magnitude. It's true that while the Fed is getting to a more neutral stance, that the bigger the hike, it is probably safe to assume. And as you get closer to neutral, it becomes a little less of a slam dunk of how much the movement. So, you're adding some uncertainty just in general. So I would think that next week it probably won't get that sort of specific guidance that he's given up until now, until we're technically at the Fed's estimate of neutral of 2.5% if they hike by 75. But I think in the wake of June and then his guidance again for July, it's not completely clear that they're going to avoid trying to nail down these aggressive supersize increases and give more guidance than what we probably think is necessary, given that there's a lot of time between July 27th and September 21st. So we'll have 2 CPI reports, 2 employment reports, a whole bevy of information on GDP and ECI and a slew of other data that I think a policymaker would rather probably hold off of making any sort of comments. I mean, if they really want to set up the September meeting, there's always the Jackson Hole conference at the end of August, as well as speeches and articles in the journal or wherever they may feel necessary to talk to reporters that they can get across their message well before September 21st. And now's not the time.
Yeah, I mean, I hope you're right. I think this constant back and forth on real-time updates, as I said in that intro, is just creating volatility, is more harm than good when you have so much volatility in the data and uncertainty about how things are going to play out. So, all right, what about when it comes to Powell's post-meeting press conference? What are you honed in on there?
Yeah, I mean, I think in general, he's going to remain and sound pretty hawkish in that inflation's the Fed's top priority. They're going to have to move into restrictive territory. Rate hikes are going to continue this year through the end of the year. He'll probably cite the fact that the FOMC September or summary of economic projections has the funds rate up above 3% or 3.25% by the end of this year. And further hikes next year are possible, that they're going to go into restrictive territory. And depending upon the evolution of the economy and inflation in particular, may have to go even further into restrictive territory. I think that message has already been widely advertised by the Fed. So I'm not necessarily thinking that there's going to be a new message here other than just kind of reiterating what he's already said from that perspective. But with the sort of inflation backdrop, we got a really strong June CPI report. The Fed doesn't want to take any additional risks here and say that, that mission accomplished, even if the July CPI report shows some moderation, at least in the headline number, like most people expect.
And you mentioned there kind of the dots and stuff. What do you think the Fed goes to, over the medium term? Where do you see the Fed funds rate peaking out and when? Yeah,
so we have it up to 3.75% to 4%. If you do kind of back of the envelope calculations and you look at the real Fed funds rate, it's still very low relative to history. Generally, kind of the rule of thumb is if you look at GDP over a longer term perspective, real GDP growth of, say, the underlying assumption of most economists is somewhere around 2% or so, a little bit below that. The real Fed funds rate over the past, say, 50 years has been about a percentage point below real GDP. So in and around 1% or so. So you're left with 1%. If you assume that the Fed funds inflation target is 2%, you add the two together, you get about 3% for neutral. So I think the level of neutral, the Fed says, is around 2.5%. It could be as high as, say, 3%. Restrictive policy with the backdrop of inflation, remaining probably above 4% this year and maybe even 3% next year, that they're only, getting going on rate hikes, that the path is going to continue. So I think there's probably some upside risk to that. It just, the Fed is probably comfortable with the idea of growth slowing, but perhaps not collapsing and sustained weakness. I think what is more likely is the Fed maybe dials back next year after they get the funds rate up to closer to 4%. But then you could see additional hikes, but it'll depend on the data. If growth is collapsing and we see negative prints on GDP on a sustained basis, it's probably going to allow the Fed to pause from marching towards, say, 5% or so. But I do think that the inflation backdrop is going to be problematic from that perspective because, on a year-over-year basis, it's going to be tough to get back down to their 2% target over the next couple of years, even with some moderation on a month-to-month basis that the Fed is looking for. So unlike other downturns, the Fed is going to be potentially like being forced, talked to by the market saying they need to cut rates. Well, it's going to be a pretty different story in that inflation is still well above their 2% target. So I think they're going to be more reluctant this time to actually cut rates if you get a negative or 1 or 2 quarters of GDP growth. Obviously they'll look at all the data, but they probably aren't going to be so quick to respond on, easing policy next year if we get some weaker growth, unlike other times when inflation was already down to 2% and they started to ease policy. So they're going to be in a much more complicated backdrop because inflation probably is still going to remain well above their 2% target in early next year, when you could start to see the economy really showing signs of slowing. We've already saw jobless claims, for example, have started to move up. This morning's Philly Fed, they are generally leading indicators, and that is worrisome from the growth perspective. And they'll probably spill some of that into the tone of the FOMC statement next week that the growth data have slowed a little bit. I think we're going to see at least some acknowledgement of that. But for the time being this year, the Fed's going to keep moving higher and get to a restrictive stance.
All right, so I'm going to jump in right there actually and say that, from a rates market perspective or market rates perspective, I do think near-term pricing is about right. But when you talk about that part next week, I agree. It's going to be very hard for the Fed to cut rates into a still strong inflationary environment. Inflation is around 5%. For right now, it seems pretty premature to be pricing in cuts. So it's that part of the idea that the Fed's going to be cutting rates to a still high inflationary environment just 9 months from now, even with the economy. Yes, things are slowing, but still kind of hanging in. I mean, it's hard to say, but that seems off for us. And then lastly, all of this, the Fed and the ECB discussion, it's keeping us as dollar bulls on the currency side. Yes, the ECB has started hiking with a larger than expected hike, but the Fed's hiking faster. And as we discussed on this weekly watch a few times, in our view, it's the growth differentials that have been driving currencies more than relative interest rates. So even with an aggressive Fed, it's easy to argue the growth risks are higher still for the Eurozone, even the UK for that matter, than the US. So, we've had a bit of a rally here in the Euro right off the bat of the meeting, but I wouldn't be surprised to see that fizzle out because the situation for the dollar still has a lot of tailwinds. So that's all for this week. Thank you, Kevin, for joining us. In addition to the Fed next week, watch out for GDP and inflation data in the US, European sentiment data, Chinese PMIs, and it's a pretty quiet week in the UK, but there's always a chance for politics. Thank you and have a good week. Thank you for joining us for this episode of the Weekly Watch. As always, please remember to hit subscribe so you can watch our latest episodes as soon as they're available. Hit the like button so it's easier for others to find.